All right, let's dig into Ooma's latest quarterly results. Now, on the surface, this was a fantastic quarter. I mean, record profits. But the stock barely reacted. So what's the deal? What did Wall Street see that maybe wasn't in the headlines? We're going to break down that disconnect.
Okay, let's start with the bottom line. Ooma pulled in non-GAAP earnings of 23 cents per share. That's the number that strips out some of the funky accounting stuff to show core profitability. And yeah, it crushed Wall Street's expectation of 20 cents. So right out of the gate, a really solid beat.
And that strength, it carried right over to the top line. Revenue hit $66.4 million, which also came in ahead of what analysts were looking for. So look, you put it all together, this was a clean beat on both of the big numbers everyone watches. But here's the thing. Despite beating on revenue and earnings, the stock only popped about 3.8% after the report. That's a pretty lukewarm response. And that brings us to the big question here. If the results were so good, why wasn't the market more excited?
To find the answer, you got to look past the top-line numbers for a second. The real story this quarter, the thing that's really driving the business right now, is this massive acceleration in profitability. This is where things get interesting.
And when I say massive, I mean it. Check this out. Their non-GAAP net income hit a company record of $6.5 million. That is a 59% jump from the same time last year. 59%. This right here is the engine that drove that earnings beat we were just talking about.
And look, this didn't just happen by accident. This was all about disciplined execution. They were really smart about managing their headcount, which actually brought their R&D spending down by 6%. And they kept a tight leash on sales and marketing costs, holding them right around 27% of revenue. Just smart, efficient operations.
And the CEO, Eric Stang, basically spelled this out on the earnings call. He hammered home this idea that they can do both. They can grow the business while also making sure that growth is profitable. So the strategy is crystal clear. It's all about profitable growth. So let's shift gears a little and talk about that growth story. Because while today's profits are great, the market is always asking, what's next? And for Ooma, the future is really tied to the success of one specific product. And that product is AirDial. This is their big solution for replacing all those old-school copper wire phone lines still out there. And the momentum here is it's undeniable. Bookings for AirDial literally more than doubled year over year. That tells you demand is ramping up big time.
And if you want to see what that momentum looks like in the real world, get this. Ooma just landed its biggest customer ever. It's a huge national retailer, and they're going to roll out AirDial to over 3,000 of their locations. A deal of that size is exactly the kind of proof point that gets people's attention. Just so we're all on the same page, this POTS replacement market is enormous. We're talking about millions of old copper lines for things like fire alarms, elevators, you name it. They all have to be upgraded. And landing a giant retailer like this is a powerful signal that Ooma is a serious player in capturing that opportunity.
Okay, so record profits? Check. A key growth driver firing on all cylinders? Check. So what does management think the rest of the year is going to look like? Let's take a peek at the guidance. And here's our first real clue about that quiet market reaction. Notice what they did. They kept their revenue forecast for the full year exactly the same. That kind of suggests they don't think that monster AirDial win will translate into a huge top-line boost right away. But at the same time, they significantly raised their profit forecast. That's a huge vote of confidence in their own efficiency.
So, this all brings us to the bottom line. What does this mean for the stock? And more importantly, what should we be looking for when they report next quarter?
So here's our call for Q3. Management is guiding for earnings per share between 22 and 23 cents. But given how strong their profitability is and the fact that this big AirDial rollout is starting, we're forecasting them to hit the high end or even beat that, coming in at 24 cents, with revenue just squeaking past the top of their range.
This really boils the whole debate on Ooma down to this. The bulls are betting that this huge AirDial win is just the beginning and that it's going to re-accelerate the company's overall growth. The bears, on the other hand, are worried that revenue growth is going to stay stuck in the mud and that the stock's low trading volume will just keep a lid on its performance no matter how profitable they are.
So, when we put it all together, we're giving Ooma a market perform rating. Look, their execution on the profit side is absolutely excellent, and that puts a really solid floor under the stock. But that's balanced by the fact that the market clearly wants to see that operational skill translate into faster revenue growth before it's willing to really reward the company.
So the key question for Ooma going forward is pretty simple. Can the incredible momentum they have in AirDial finally be enough to reignite that top-line growth and win over a skeptical market? That's what we'll all be watching for next quarter. And as always, this is not financial advice.